Thank you very much. It's a pleasure to be here again. I want to note that my first trip to Zimbabwe was just a month ago after the collapse of their currency, and our strongest advice to them, they've dollarized and are literally using the US dollar, was to continue that regime and not to reintroduce their own currency anytime soon. So I would have to defend the Fed today, having endorsed Zimbabwe's embrace of the US dollar. Our topic is fed up with the Fed, should we abolish? This is not a topic about whether the Fed should adopt a different policy regime, such as a gold standard, but whether we should have a central bank at all. I can't resist noting Gene and I debated the topic of the gold standard last year, at which time the price of gold was $970 per ounce. This morning it was $912. I just thought you would like that market update. So the first half of the topic, fed up with the Fed, calls for a review of Fed policy. Has it been good? Has it been bad? What's the scorecard? And I don't want to go back through the entire history of the central banks. Central banks generally don't have a very good history and track record, and the Fed certainly has its black marks over its history as well. But let's look at where the world has come in the last several decades, because a lot has been learned, and monetary policy has been dramatically better around the world, including here in the United States. So let's start with Paul Volcker's Fed that killed the inflation of the late 1970s, when the inflation rate in the U.S. got up to 14% or so. Since that time, it's averaged about, or since 2 years after that, as he brought the money supply back under control, inflation has averaged about 3% per annum for that several decade period. Real GDP has averaged about 3.2%, which is its average for the last several hundred years in the United States, up through the first quarter of this year. And over this decade through 2006, leaving out the recession that we are now in, it averaged 3% per annum. Over this period, we had about half the number of recessions, this last 30-year period. We've had about half the number of recessions that we did throughout our previous history. The Fed's record in these last several decades is not all roses, however, as you know. The Fed did keep interest rates too low for too long between 2002 through 2004, contributing to the housing price bubble. This is true. But low interest rates had other market forces contributing to the low interest rates as well. An overvalued U.S. dollar produced large and growing trade deficits that sucked dollars in from China and other countries, keeping interest rates low. With a gold standard, interest rates would have been even lower until the trade deficit was reduced, as all adjustments would had to have been made through domestic prices. Markets are the best way of reconciling conflicting forces and moving the economy forward, but because it's the best system doesn't mean it's without its challenges and difficulties and hardships. How has the Fed performed in the last 2 years? The Fed responded to the financial crisis emanating from the collapse of the real estate bubble in several ways. First, on the monetary policy front, it reduced interest rates in the face of a collapse of aggregate demand to soften the impact of the fall in housing and other asset prices, and prevented a collapse in the money supply after September 2008, September of this last year, by doubling base money. These traditional central bank functions helped restore confidence in the financial sector and moderate moderate the inevitable recession as the economy deleverages and adjusts to new realities. In this area, the Fed has performed very well, not repeating the mistakes that it made during the Great Depression that contributed to the Great Depression being what it was. On the credit policy front, the flow of credit froze up as financial markets began to realize the extent of potential real estate losses and started to deleverage. The Fed introduced new facilities to help specific credit markets, buying mortgage-backed securities and commercial paper, to name two. This is not a traditional central bank function. The Fed should have had greater faith in the market's ability to develop new credit channels and to redirect credit to the most productive uses. In this area, Fed performance was helpful in the short run, but harmful in the long run. It was inappropriate, and the Fed should unwind these activities as soon as possible. On the failing institution resolution front, the Fed joined the Treasury in ill-advised, damaging, and for the Fed, inappropriate and possibly illegal market interventions to save investment banks and an insurance company. This was motivated by the lack of legal tools with which to resolve failing non-banks in the ways banks may be resolved, but it was an end run around the law at a time of panic. It is also hard not to wonder whether personal Treasury relationships and past and potentially future employment on Wall Street clouded the judgment of Treasury and, to a lesser extent, Fed officials. One way or the other, the rules of the game have been changed and are now unclear. The long-run damage will be difficult to repair. So should we get rid of the Fed? The answer, I'll provide mine and you can then come back with yours. The answer depends on whether we believe not having a central bank would be better. In time, alternative arrangements could be developed to clear and settle payments across different banks or different institutions of payment and to print and coordinate the value in the market of private currencies.
Can you wrap it up?
Yeah, okay. The benefit would be the benefit of a purely private monetary system would be clear rules with very strong market discipline and private behavior. These are important benefits. The costs would be periodic financial panics and crises that would very likely overturn the system with massive government intervention. Let's not throw out the workable for an imaginary utopian best solution, and I will leave that to my partner to elaborate.